So think about it. We're walking into the bank front door. We look to our right, and the banker is like, hey, deposit your funds here. And I'll tell you what the national average right now for deposits, which is astonishing because banks are flush with digital cash, and they haven't raised the average return rate for checking and savings accounts, but it's 0.24%, right? 0.24. So you look to the banker and they're like, hey, deposit your funds here. We're offering a crazy high rate of return of 0.24%. Okay, so I deposit my funds there. Then you look to the right or left, I should say, and there sits a loan officer. They're like, get a loan over here. We have loans as low as 5%. All the teller did was walk your money over there, and you're borrowing your own funds. Think about the rate of return on that. So for folks that are entrepreneurs and probably investors as well, guess what the negative rate of return is on that investment? 3,600%. Negative. But what was the rate of return for the bank? Positive 3,600%, right? So again, the power of arbitrage. I don't care if we have nuclear war. Banks is a business model that will always be profitable and always be in existence. You look at every major city you go to. What is the tallest building? What's the tallest skyscraper? Who owns that? Banks. It is a massive, massive profit center. So there is no laws or regulations that prevent the American citizen from doing and executing on the exact same strategies that the banking system does. And that's what we expose. And so a mortgage was changed after 1913 because the banks got together and said, all right, obviously deposits are extremely important. So how do we grow core deposits? And they looked at what the average American, where they were storing their cash at the time, was in their mortgage because it was liquid. Money can move in and out freely, right? So they said, we got to stop that. We need to come up with what's called a segregation income system, right? So it segregates your cash flow. So they made a mortgage, the modern day mortgage. Again, when I say mortgage, again, by the way, let me reverse course here. A mortgage is Old French for death pledge. Just so we're all clear, 99% of us Americans are going out and refinancing and signing up for a mortgage. It's the root of it is death pledge. So you're signing a contract to death. And most Americans, most Americans don't pay off one home in 30 years. But there is a couple societies around the world that never adopted our banking system. One that's very popular is Australia. The average Australian pays 2 homes off in 14 years. They also have the highest rate of second home ownership, meaning they have a primary residence and a vacation home. And those 2 homes get paid off an average of 14 years because what I'm explaining to you, they learn in high school, right? About money and finance and how the banking system works. So they came up with a mortgage work and made it closed in. That was the key. Let's make it so that money can move in freely, but it can't come out freely. It's a closed-in product, which really was the catalyst for a lot of other products like car loans, personal loans, anything that's an installment loan, student loans, right? Money goes in freely, doesn't come out freely. So what does that force you as the consumer to do? Are you now going to put 100% of your resources and cash flow into your mortgage knowing that it's trapped? No, because when it's time to pay your bills and utilities, you can't, it's trapped. So a HELOC, a home equity line of credit, is the old way of financing real estate. Money can move in and out freely. If I put 10 grand into my HELOC today, guess how much I have available, depending on what the balance started out with and how much I've already paid it down. But guess how much is available to me today?
Still get that 10,000. Yeah.
I can take it out anytime I want, 24/7. And the cool part about the digital age now is I put money in, I just use an app on my phone and say, okay, I actually want to take the 10 grand, I want to move it over here. And within a split second, it's moved. Money moves in and out freely. Here's the key to that. What does that do for you as the consumer? Now it gives you the confidence to do what Dave Ramsey tries to preach on, which is rice and beans and to pay extra towards your mortgage. Less than 2% of Americans actually pay extra on their mortgage because they know that it's trapped. Should they need to have access to it, there's 2 expensive ways to do it. One, refinance, which costs thousands of dollars, right? Even if you went to a lower rate, what are you doing? You're starting the amortization schedule all over again and going back to square one. or two, sell the house. That's not attractive. So we want to have access to it, where with the home equity line of credit, I've got access to it. So it gives me the confidence that, hey, even my nest egg, I can put towards my home equity line of credit, which reduces the balance. Thus, it reduces the interest I pay the next day. That's another difference between a mortgage and a home equity line of credit. So you put money in today, tomorrow, I'm paying less interest. On a mortgage, you're going to have to wait a long time before you're actually paying less interest on that mortgage because you chunked towards it, right? But again, I'm liquid. So if life events happen, I have access to my capital. If opportunities, your group is probably an abundance mindset group where they're always looking for opportunities. They're entrepreneurs, right? You're risk takers. You're looking for opportunities. So when opportunities present itself, I am massively liquid. I have access to my capital within a split second to go capitalize on those opportunities. A story that I had was a previous business partner. He had a neighbor who was an attorney, and you could tell he was falling on some hard times. Like his yard, the grass was growing up and whatnot. He was barely leaving the house, and he's walking the dog. So he finally just, asked him, he's like, "Hey man, what's up?" I said, "Man, lost my job, got a divorce, and my house is going to be foreclosed on in 4 days." He's like, "Dang, that sucks." So you got 4 days, right? So my former business partner's like, "I got a proposition for you. How about I buy the house before it forecloses? It's going to save your credit score, right? And then I rent it back to you. And it looks like, we need some repairs and stuff too. So I'm going to give you some cash so you can do some repairs and cut the yard and all that, which what does that do? Drives up the equity in the home." So if he had a mortgage and said, "Hey, I've got to pull out $300,000 today because I have equity in it," are you capable of doing that in the mortgage? No. What are they going to tell you? Well, it's going to be 30 or 45 days. We're going to need tax returns. We're going to need W-2s. We're going to need pay stubs. We're going to need to look at your bank statements and all that. We're going to have to get a verification of employment and verify with your employer. Then we got to get with the title company, and then that's going to cost thousands of dollars. And then, oh, by the way, you're going to pay us origination points and underwriting fees and processing fees. You get the point. It's archaic, right? So if he had a mortgage, he could not have capitalized on that opportunity. But because he had a home equity line of credit, in a split second, he was able to pull cash out, buy the home, prevent it from foreclosure, and it turned into an asset for him, a cash flow asset. So now he's receiving rent. So he obviously the rent that he's receiving from this attorney or former attorney at the time, I don't know if he ended up getting back on his feet and getting a new legal job, but obviously there was a margin between what he owed on that house via his home equity line of credit, which again is an interest only payment, versus the rent. So now he's got more cash flow. So hypothetically, let's say before this transaction, he had 10 grand coming in a month. Now he's got 12 grand coming in a month. Well, when you have higher cash flow, what do you think happens to the home equity line of credit when you increase your cash flow? It speeds up the pay down process. So again, that's when we get into replace your banker and some of the other concepts of, hey, if you just want to be debt free, we found no better strategy to becoming debt free with, I wouldn't say ease, but without the rice and beans method and the gazelle-like mentality method and on your existing budget, we haven't found anything better. But the liquidity is what gives you the ability to go acquire more cash flow assets. And again, your audience is entrepreneurs. How many cash flow assets do we want to acquire on a yearly or monthly basis to replace? Do you have a lot of your clients or audience that is what I would call W-2 capitalists? So they're still in a job earning a W-2, but they're scaling up their side hustle.
There's a portion of those, yes.
Yeah. So think about that. If you got capital to not only scale up your side hustle, but go acquire other cash flow assets that complement your side hustle, you can evict your employer, or what I call fire your boss, at a much faster pace. If you want to. Some people are like, "Nah, I love my job. I like being told what to do. I like clocking in." That's fine. If you like it, no problem. But the point is it gives you options. At least it gives you the option to make those decisions, and the decision is left up to you whether or not you fire your boss or not.
Yeah, leverage. What I hear all through what you're saying is what everyone would really wish they had with their money is leverage.